bringing you the latest in tax credit news, insight, and analysis. This is Tax Credit Tuesday with your host, Michael Novogradac.
Hello, I'm Michael Novogradac, and this is Tax Credit Tuesday. This is the September 10th, 2024 podcast. Today, I'm joined by three of my partners for the first of a two-part podcast series on the current state of the community development tax credit market. As those of you watching on YouTube can see, my guests are my partners, Brad Elphick, Dirk Wallace, and Tony Grappone. Today's Tax Credit Equity podcast, as I noted, is being recorded in two parts. The first part will be a discussion of the range of current tax credit equity pricing and the terms that we're seeing for various tax credits. The second part, which we'll post next week, will be a discussion of the future of tax credit equity pricing. There are many potential regulatory, legislative, and/or economic developments that would affect equity pricing. Part two will enumerate many of those potentialities and the pressure that such developments would have on equity pricing, positively or negatively. Now, the focus of our discussion of community development tax credit incentives is going to be in four key areas or four major areas. There's the long compensating tax credit, the new markets tax credit, the historic rehabilitation tax credit. Those are the first three. And the fourth area is really a variety of tax credits through Keep Clean Energy. Now, many of our listeners and viewers are involved in only one or two of these tax credit equity areas that we're going to discuss today. That said, I do encourage you to listen to this and the next podcast, as the broader tax credit equity marketplace has iterative effects. What is happening in one area has direct and derivative effects on the other. In short, what happens in one tax credit equity market influences the others. What happens in a tax credit equity market doesn't stay in a tax credit equity market. Before getting to our guests, I did want to do some level setting. We can start with the estimated size of the tax credit equity markets for the four incentive categories we're discussing today. We can start with the historic tax credit market. Now, it is an uncapped market. That said, it is roughly $1 billion a year in tax credits. Now, the new market tax credit is capped, and the annual cap is $5 billion in tax credit issuance authority, which, if you multiply by 39%, means it's roughly $2 billion per year. And as listeners know, the new market tax credit is set to expire at the end of next year. And obviously, we're hoping for permanency as part of a tax bill, either at the end of this year or next year. The low compensating tax credit equity market is notably larger, in the $20 to $25 billion a year range. And when you think of the low compensating tax credit equity market, you really need to think of it as two markets. There's the 9% market, which is capped, and that's about $10 billion a year in tax credits. And then there's the 4% or productivity bond financed credits. And they're indirectly capped by the cap on productivity bonds. That said, not all productivity bonds are used for residential rental housing. And recent estimates are that market, 4% market, is about $15 billion. And the addition of the two gets to the $25 billion. Now, the one tax credit market that is considerably less predictable or estimatable, but is most certainly growing, is clean energy tax credits or tax incentives. Now, there's several reasons why it's less predictable or estimatable. One is that most of them are uncapped, so that certainly makes it more challenging. Many of the provisions were enacted through the Inflation Reduction Act, and they're new, and we're still seeing them roll out. And then many of the clean energy credits are also now, thanks to the Inflation Reduction Act, refundable for many tax entities, or more generally transferable to other taxpayers. All of these makes it more challenging to estimate what the clean energy tax credit equity market is. That said, most estimates put the market at more than $20 billion, and some estimates are well above that $20 billion amount. And as I note, it is most certainly growing. As time passes with the provisions of the Inflation Reduction Act getting more fully implemented, the clean energy equity market is certainly going to become clear, grow, and the size of the market will become clearer. Now, beyond the size of the general tax credit equity market, there are crucial factors that affect the demand and equity value for tax credits. Some are individual to a given tax credit, such things as the period over which the credits are claimed, the timing and amount of cash distribution an investor expects or is promised, when the tax-free equity investor can exit, when contributions associated with those equity purchases need to be made. So there's a variety of very specific transactional matters that affect the value. And then there are broader, more general matters, such as future regulatory or legislative developments. Now, we're going to talk about some of these factors in this podcast, and we'll discuss them in more depth in the second podcast in this series. So as you can hear so far and see, we have a lot to get to today. So if you're ready, let's get started. Brad, Dirk, and Tony, welcome back to Tax Credit Tuesday.
Thanks, Mike.
Yeah, thank you.
Thanks, Mike. Glad to be here.
Well, appreciate the three of you joining me. I know you're all very busy. Appreciate making time for our viewers. So you've each been on the podcast many times. You're old pros. Tony, I think you're the leader in most appearances. I think today is your 17th time. And then Dirk and Brad, you've been frequent guests as well. And each of you also sat in for me as a guest host earlier this summer. Thank you for that. Before we jump into today's topic, though, I would like each of you to give our audience a sense of what you do work-wise in serving clients at Novogradac. And Brad, I'll start with you, and you could share some of the services you provide to clients at Novogradac beyond being the leader of the New Market Tax Credit Working Group.
Yeah, great. Thanks, Mike. Glad to be here again. Always trying to catch up to Tony and the number of podcast appearances. So appreciate you letting me, but next time, maybe not on the same podcast.
I was going to say, this is going to keep you from getting behind, but not catch up.
But yeah, so in addition to podcasting, work a lot with developer clients in the low-income housing, historic, and new market tax credit space. Obviously help with doing the audit work, and other test engagements, tax returns, but also spend a lot of time doing transactional work, forecasts for these types, working with investors. And then, as you mentioned, also leading the New Market Tax Credit Working Group.
Great. Thank you, Brad. Dirk?
So Tony, not sure if you heard that, but we were co-hosts, Brad and I.
That's right.
I know.
Not just participants.
I know, exactly. I'm waiting for an opportunity to host one of the podcasts.
I think that counts as like 5 appearances.
There you go.
That's what I was thinking.
So, but yeah, so I work in the LIHTC industry. I work with a lot of developers, syndicators, investors. Pretty much work on fund level audits, lower tier audits. Do a lot of forecasting. Do some due diligence procedures on people looking to purchase maybe a new investment. And as Brad heads up the New Market Tax Credit Working Group, I head up the LIHTC Working Group.
Great. Thank you, Dirk. Tony?
Great. Yeah. So, the reason why I've been a featured guest on the podcast so many times is because about a year ago, Mike and I launched a special sort of segment within the podcast series referred to as the Renewable Energy Project Finance podcast series, which is a monthly podcast. And so that gives me an opportunity to participate in, several of these podcasts as opposed to my other partners. But yeah, so in terms of services here at the firm, I oversee 3 different silos of services. I've got one silo that's primarily transaction advisory related. And so that group consists of folks that, they work on a lot of tax equity transaction models, cost segregation services, and related consulting around forecasts and cost segs. I also oversee a silo of financial statement audit and attestation services. And so those folks spend most of their time working on financial statement audits for partnerships that own and operate tax credit types of projects. And then a third silo is tax return related services. And those folks obviously specialize in preparing tax returns for tax credit partnerships.
Great. Thank you for that, Tony. Thank you, Dirk. Thank you, Brad. So let's get into the meat of today's podcast. And for our audience, Tony will be focused, as you can guess, on clean energy equity market. Dirk will be focused on the locally tax equity market, both 9% and 4%. And then Brad's going to do double duty. He'll be focused on new market tax credits and historic tax credits. So Brad, let's start with historic tax credits. Of the kind of four categories, it's the smallest in terms of the annual equity markets, roughly $1 billion. $1 billion is a lot of money, but it is the smaller of the four major community development tax credit areas. So tell our audience what you're seeing with respect to equity pricing for historic tax credits. As you know, this topic came up during my testimony in front of the Senate Finance Committee at the end of July.
Yeah, happy to. And, there are a lot of similarities between the historic tax credit and the new markets, tax credit markets. According to a recent survey that the Historic Tax Credit Coalition did, average credit pricing is kind of around that 79-cent range, which is actually, has been coming down ever since the Tax Cuts and Jobs Act. So you've seen a decline in equity pricing as it relates to the historic tax credit. And, there are definitely some things that are contributing to that. And we'll talk about those in a little bit more detail on our next podcast. But really, I think that as we look at the, where the pricing is for historic tax credits, you can kind of look at different things impacting it, such as competition for other tax credits, which we'll talk about a lot today. There's also this change in the fact that there's no more transition deals that could claim the credits in 1 year instead of over 5 years. I think that that's had an impact in terms of where pricing is now. And then I think there's also, the demand for higher yields from certain investors have had an impact on pricing. So I think that, where we see pricing at 79 cents now, definitely, softer than where it was in the prior year. And, it'll be interesting to see with what happens over the next, 15 months or so with legislation and, with other tax credits, what pricing may do for historic tax credits.
Yeah, I look forward to our in-depth conversation on some of the other factors that are coming down the pike, if you will. Most notably, perhaps, could be a major tax bill next year. But let's turn now to new markets, tax credits. Share with the audience what you're seeing in terms of new market tax credit equity pricing.
Yeah, as I mentioned, pretty similar. We're seeing price range typically between 78 and 80 cents. Typically, those that are more investors that are more CRA driven, you may see pricing on that higher end of the range. But similar to historics, there's been a softening in the tax equity markets for new markets as well. It hasn't been as dramatic of as a decrease, but over the years we've seen it as be in the high 80-cent range. It obviously took a tremendous dip during the pandemic, but then has restored itself back to kind of that 80-cent range. It is interesting. I've been talking with investors and surveying some of them in terms of what the tax equity market may look like for the remainder of this year and next year. And most of them do indicate that there has, been a softening. It will likely be this kind of softening in the pricing, maybe a penny or two. However, I think it's worth noting that even in spite of those comments, they do talk about the resiliency of the pricing for the new market tax credit, and that where, they thought there would be more drag on the pricing to do some of these other factors that we'll talk about. It's actually been pretty resilient and staying around that 70 to 80 cent range. And so, I think that that's been good for the tax equity markets for new markets.
Right. So Brad, do you have and when you talk about pricing and you say it's 78 cents, and is new market pricing impacted by location at all, or is yours? And when I say yours, is new market tax credits more of a national price versus, a regional or state price?
Yeah, so that's a great question. New markets is heavily impacted by CRA investors, and so depending upon where the CRA markets are for those investors, you will see premium pricing. So to some extent, there is a geographical impact on pricing, and so There's also, rural transactions. You may see a little bit lower pricing for different reasons, investments in native areas and such. So there is definitely some geographic impact to the pricing.
A good question, Dirk. I was going to sort of follow up in a sort of similar vein as when I think about historics and new markets. I think how new markets investors are very driven by the Community Reinvestment Act eligibility or qualification. Historic credits, not as much. So definitely new markets has that feature. Historic credits, there's generally an expectation of cash flow, modest amounts of cash flow, which you don't see with new market tax credits as much. They are both taxable credits,
Right.
in the sense that there's a 100% basis adjustment associated with both of them. And then the new markets is claimed over 7 years and historics over 5. So it's interesting how you hear the pricing, but then you have these other aspects of the actual design of the credit and eligibility for non-cash flow related or tax benefits from the different credits, which all kind of roll into the price. And I mentioned that those credits are both quote taxable and that there's a basis adjustment. A lot of the tax credits don't have a basis adjustment. So now, Dirk, if you could talk, and they also, long-term tax credits do have the benefit of investors getting reinvestment credit if they're a bank and are driven to make investments in that way. So share with us the current state of the tax for equity markets for long-term tax credits, Dirk.
Sure. So I'm seeing a broad range of equity pricing, and then really kind of saying it's 88 cents or 87 cents or something like that. When you look at the loan causing tax credit, it really does depend on region, maybe even city, CRA market. Location really is impacting pricing a lot for loan investing tax credits. When I think of kind of low ends and high ends, we're seeing some prices into the high 70s, and then we're seeing prices into the low 90s. So a lot of times when you see kind of a national average, you see maybe 87 cents, 88 cents, something in the high 80s. But really that's nationally. And to get an average, you have to have prices that are lower and prices that are higher. And really you do see that broad range of pricing. So I know we've been talking with syndicators and investors, getting feedback on equity pricing, and we actually post those results, I know, quarterly, and typically we do it on a national level. We've always kind of looked at a national average price. But I did want our listeners to know that we have rolled out a new mapping tool, and this mapping tool is going to look at regional pricing. So there's going to be 7 regions, and within those 7 regions, we're even going to have pricing on 11 states. So these will be average prices again for per credit for those regions and for those states. Even within a region, if you're in North Dakota versus Oklahoma, or if you're within Oklahoma City versus rural city in Oklahoma, there's going to be differences in pricing. But this is to kind of look at a more regional, I guess, the regional dynamics of LIHTC pricing, and hopefully give our listeners and readers a better idea of what it's like in those regions.
Great. Thank you for that, Dirk. And I would just note for our listeners, the long-term tax credit is claimed over sort of 10 years, really 11 years, the 10-year span, but there's year 1, there's a lease up rule, and where you don't get year 1, you can get in year 11. And most investors are looking as generally a 15-year investment. When you compare it to kind of historics and new markets, you certainly will see sort of higher upward pressure equity pricing because there's no basis adjustment or increasing value, but the credit is claimed over 10 plus years. So that it creates downward pressure compared to the other credits. So it is interesting just to line up the various credits and try to understand what the different reasons are that there's differences in equity pricing. And obviously you share the importance of CRA for long-term tax credits and their equity pricing. So with that, Tony, we will. I'll go to you. And Brad's really discussing 2 credits. Brad's talking about historics and new markets. Dirk's sort of talking about 9s and 4s. And you have a much wider menu. Broadly speaking, there's investment tax credits, and people think of solar ITC when they think of renewable energy and clean energy and the rest. And then there's also production tax credits, which you claim over time. ITC you get when the property is placed in service. Production tax credits you get over time. And then there's a variety of other tax credits. So if you could discuss that, the equity markets.
Yeah. Yeah, I'll
Frame
try.
it for our listeners in a way
Yeah.
that isn't a full podcast.
Exactly. Yeah, I'll try and keep it brief. But yeah, you're right. There's when it comes to the renewable energy tax equity market, there's a lot more variables and factors that sort of play into the pricing. So it's harder to just provide just kind of like a basic range of tax equity pricing, and the range you can see across the renewable energy industry is quite wide. I noted Brad's comments about historics and new markets, where it seems like that pricing fits within a pretty narrow band there. Whereas in renewables, a lot of different factors that contribute to the pricing. So like PTCs, for example, that's a 10-year tax credit. And so those credits, these days, if you're talking about wind and solar, you might see typical PTC tax equity pricing sort of in the 90-ish range, cents per dollar of credit. Okay. And then in the PTC tax equity market, you can see the equity contributed in sort of two different phases. You've got most of the equity comes in sort of that 90-ish cent range. And then there's a balance of equity. Maybe 20% of the tax equity investor's commitment is oftentimes paid in under what we refer to as a pay-go structure. And so every year, as the actual credits are determined, that creates some sort of additional capital contribution from the investor over the 10-year period. And the pay-go credits can get monetized at a higher rate. So you might have, say, for example, 80% of the investor's total commitment is priced in sort of that 90-cent range, and then the pay-go portion might get priced in closer to $1. Okay. And then in the ITC market, as you said, that credit gets generated and claimed in the year you place the facility in service. And so those credits, from a time value standpoint, are worth more. And so if you're talking solar ITC or standalone battery storage ITC or solar with battery, I'd probably say the sweet spot range is sort of in the $2 to $10 range right now, which I'd say is probably down, 5 to 10 cents from a few years ago. And I think the dip in pricing, is caused based on a few different things. Number one, you've had higher cost of capital increases over recent years. So you've got higher yield requirements, which impacts pricing. And then you obviously have just all the new credits and expanded credits provided for under the Inflation Reduction Act. So you have greater supply that affects pricing. And yeah, and then you've got other things like that we'll get into in more detail, like Basel III, et cetera. And so those are kind of your more typical pricing for your tried and true technologies. If you're working with more of an emerging technology, then the pricing drops. The Inflation Reduction Act provides credits for new technologies that we've never seen before. So because those are newer, not quite as known by investors, you see that in the pricing. And then you can also see drops in pricing based on geographic area. Deal size. Typically larger utility scale projects fetch stronger pricing. Smaller distributed generation or C&I style projects typically fetch smaller pricing. So you could have sort of a multitude of factors that contribute to the pricing.
So one question that I get a lot, back to tax credits, I used to get it with the local tax credit when it would trade at more than $1 before the corporate rate was cut from 35% down to 21%, but that's another podcast. You mentioned that the production tax credit or the ITC can trade at $1.02 to $1.10. Question I'll get oftentimes on Capitol Hill, members of Congress or their staff will say, how can a tax credit sell for more than $1? So please explain to our audience.
Yeah.
Pay more than $1. We know that a tax credit is a dollar for dollar offset on your taxes, but paying more than $1 in and of itself for that tax credit wouldn't be wise. So there are other economic benefits. So enumerate the other economic benefits for our audience.
Yeah, great follow-up question. So yeah, when we talk about pricing, we're really talking about the sort of capital commitment ratio relative to the credits they're expected to get back. Okay, so that's just like industry use terminology. But really what we're talking about is that investor is going to be a partner in a partnership. And so although they just refer to their capital commitment relative to the credits, because they're a partner, they're gonna get allocated at all of the partnership, their share of all the partnership's attributes, okay? And so if you wanna sort of unpack that pricing on ITC investments, the most significant portion of the investor's return is gonna come from the tax credit. But then the investor can also expect to get back a significant portion in the form of tax depreciation benefits or tax loss benefits driven by tax depreciation. And then lastly, they do get some of the actual cash flow that gets generated from the partnership. A lot of tax equity investors in renewable energy require what's called an annual priority return, which is usually a percentage of their equity contributed to the partnership comes back to them as a preferred distribution. And then obviously in renewable energy, you see what's called partnership flip transactions. And at the end of once the investor has sort of vested all of their tax benefits, there's usually a sort of like a call option period where the sponsor has the option to buy the investor out. And so that buyout price is also part of their return stream. So the investor usually has four main components of their benefits. They've got the credits, which is the most significant, tax loss benefits, cash flow benefits, and then an anticipated exit payment to leave. And when you add up all those benefits, they exceed the pricing. So the pricing might be, say, $1.05, but when you add up all the benefits they get back, the benefits exceed the $1.05.
Right. Thank you for that. And I always find the renewable energy investment tax credit interesting in that we mentioned the new market tax credit, the historic tax credit, 100% basis adjustment, long fuzzy tax credit, no basis adjustment, renewable energy investment tax credit, 50%.
That's right.
Adjustment.
I know. Yeah. Yeah.
I'm not aware of 25% or 75% base adjustments.
No, I really like to, I get to review a lot of tax equity closings throughout the year, and I keep a spreadsheet that tracks every closing. And whenever I review a closing, I look at the tax equity investors benefit schedule, and I try to sort of unpack the pricing a bit to try to figure out how much the investor values the credits versus the losses versus the cash. And I kind of keep a running total of that, a summary tab that kind of shows you your sort of blended average value that they place on each one of those benefit streams. And it's interesting to kind of see that evolve over time.
And just for the audience, this whole taxability nature of the space adjustment has to do with whether or not losses that you receive beyond the cash that you receive relative to your investment, that those losses in excess of the cash and in excess of your basis become permanent benefits if there's a no basis adjustment, and they become more timing differences if there's a basis adjustment with respect to the portion of basis adjustment. So that is a notable effect on value. So Tony, there is the refundability of certain clean energy credits for certain tax exempt entities. And there's also the ability of owners of facilities to transfer certain clean energy credits to buyers. So it's, for the first time in any notable way, federal credits, tax credits can be sold as if they're property. And that is unique. And we know we had to wait for IRS regulations to stand up the transferability market. And we're 2 years plus out from the Inflation Reduction Act, and that market is just now standing up. What influence are you seeing in either sort of refundability and or transferability and its impact on equity markets, the clean energy equity markets?
Yeah, great. So in terms of the direct pay market, that's the refundable credit, and that's available for tax exempt state and local governments and a few other types of designated entities. I haven't seen the direct pay benefit really have much of an impact on the tax equity market. What we're seeing with elective pay or direct pay is we're seeing a lot of small tax exempt entities are opting for elective pay as opposed to trying to put together a complicated tax equity structure to monetize the credits. Okay, prior to the IRA, if you were a tax exempt entity and you wanted to monetize tax credits, you had to put together sort of a complicated tax equity structure to do that. For a lot of nonprofits, that was just cost prohibitive to do. So they were kind of boxed out of participating in clean energy in many respects. So elective pay is great because it allows a lot of small tax exempts to be able to participate in renewable energy in ways that previously they didn't have really much of an opportunity to. But because those are all small deals, it's not really having a major impact on the tax equity market. When you look at transferability, though, transferability, like you alluded to, that is such a game changer, right? So, prior to the IRA, if you wanted to use federal tax credits from renewable energy facilities and historics, new markets, and low income housing, you had to be at least a partial owner in the property that qualified for the credits. Well, now under the IRA, you don't have to be a partial owner in a renewable energy facility to use the credits. You can just purchase the credits as a non-owner, greatly simplifying the process for tax credit buyers to want to use these types of credits. And so earlier, when you mentioned how the renewable energy tax equity market is estimated to be, north of 20 billion, we've definitely seen what at least a 20% growth in the tax equity market this year in renewable energy. And I would say most of that is coming from the transferability market, corporate taxpayers who previously weren't participating in the program that have now gotten into the renewable energy space due to the simplicity of just buying a credit as opposed to being a full-blown partner in the partnership.
Tony, to what extent do you think that the transferability of clean energy credits to certain corporate investors that haven't invested before is a gateway for them to eventually become direct equity investors?
It's okay, great. So you're almost sort of reading my mind there because I wanted to kind of elaborate a little bit further to say what a lot of folks in the industry are hoping is, which is exactly that. It's the gateway, and usually, in my experience, that tax credit buyer, if they're just a buyer and they're not a partner in the partnership, their overall return is probably lower than what it would be if they were investing in the partnership and getting all the other benefits that they access as well. And so we kind of hope that these tax credit transferee buyers will become familiar with the renewable energy industry as a transferee buyer, gain comfort with the program, like what they like participating in it, see sort of the overall success track record, and then motivate them to kind of take that next step and be a partner in the partnership.
Now, and I think that hope is based in part on historical experience.
Yeah.
When we've seen in a variety of ways, and corporate investors will step in different structures that are lower risk, easier to explain internally. And then as they get a comfort level and they see, ability to get slightly higher yields by going more direct, that it kind of evolves in that direction.
We've already started to see a little bit of that. And it's great, right? I mean, it benefits the whole entire tax credit industry. And a lot of the, once these investors start participating in one of the tax credit programs, they oftentimes look to the other credit programs to see what opportunities exist there as well. So I see transferability as, in the long run, just a huge win for the overall tax credit industry.
No, I appreciate you pointing that out. And that is the overall purpose of this podcast and the podcast series, where generally is increasing knowledge, increasing comfort level, increasing efficiency, such that the equity pricing for tax credits rises, so that more good gets done for a given cost to the federal treasury. So, Brad, from the standpoint of new markets, historics, I mean, you've had a number of discussions, with investors. There's been a lot of trepidation among the non-renewable energy community development tax credit areas as to the impact of transferability, elective pay, and just the broader supply of renewable energy tax credits would have in a derivative way on the other tax incentives. And certainly the fact that new markets and lump tax credits have a unique place within Community Reinvestment Act regulations has created some real stickiness to their equity pricing. Historics, not so much. What's your current take on the impact of renewables on the historic and new markets? Then I'll get to you, Dirk, in a moment on LIHTC.
I think what it really shows is the impact legislative change can have when you expand the investor market and make the credit more accessible to more investors, is that, you have more looking at, renewable energy tax credits and other incentives because now it's easier to use it. You don't have to become a partner. You can use the transferability. And I think that, that obviously has been attractive to certain types of investors. And so has maybe taken some of the focus or the appetite away from new markets and historics, because they can put dollars into those types of transactions, more easily. And I think as we're talking about kind of the legislative changes that you can make to some of these other credits, I think those are all kinds of things that, it's important to look at is how do we make this more accessible? Because there is such a, history of success for new markets and historics. As you said, there's kind of this place for them. It's never a discussion of, can you replace one credit? Should one credit replace another? It's really more the, how comparable they are to each other and the mission that they're serving. So while it has had an impact, I think it also kind of, gives us a way to discuss how can we create parity between the credits so that there isn't, any notion of cannibalizing, investor dollars. So I think that that's kind of what we should more focus on in terms of, how do we make new markets and historics just as attractive for investors and make it more accessible. For new markets, it's mainly financial institutions, many of which are CRA driven. And, that traditionally has been the case. It doesn't really work as well for individuals. And in the secondary market, there can be changes. So all these things I think could offset maybe some of this temporary impact that, that we're seeing with the influx of all of these other investment options.
Right. Thank you for that. And I would note for our audience that while new markets and LIHTC are per se community reinvestment act eligible as a general rule, historics and renewables can get credit. However, they're not per se. They have to be targeted to low-income or moderate communities. And there's other hurdles, which is why they're not as directly impacted by the community reinvestment status. I also wanted just to note that when we talk about transferability of renewable energy tax credits, we at Novogradac had explained to Treasury how we thought that transferable credits should be transferable to individuals, and individuals should be able to use the credit irrespective of the past activity rule or limitations. And unfortunately, Treasury didn't see it that way. So as a practical matter, the individual investor market did not open up to transferable credits. And at this point, either have to take a wholesale change in the regulatory environment at Treasury, or it would take an act of Congress to open up the transferability market to individuals. So right now, it's essentially a corporate transferability market. I assume you agree with that, Tony?
Indeed. That's right. Yeah.
Unfortunately.
Exactly.
You wish you could disagree.
Well, and Mike, I would add too, I think it was great to hear some of that conversation at your testimony in front of the Senate Finance Committee about how can we make these all work better together. So I think that that's an important conversation, and it's good to see it being held at that level.
No, I thank you for that. And then Dirk, tell me how the renewable energy market, how you've seen it influence the long-term tax credit equity market.
Sure. And I think I'll start with just a question for Tony, or just to build on what Tony had said about the transferability market really being more corporate investors, because I know a lot of low-income housing tax credit properties now are seeing a solar component on their properties. And the thought being, well, if my housing tax credit investor doesn't want the solar credits, can I just transfer them to another investor and have them, pay for the credits? And in theory, that's, a great idea. But it sounds like the corporate investors, they may not be looking for $100,000, investment in solar credits. I guess, what is that size of the transferability market, and why the low-income housing tax credit properties maybe don't fit into that kind of sliver of solar credits?
Yeah, good question. So even though I said, corporates, it's mostly corporates that we're seeing, but, you get banks that can do it as well, insurance companies, et cetera, widely held C corps for the most part. But in terms of the affordable housing properties that generate solar credits, Yeah, the credits, the ITCs on affordable housing properties tend to be pretty small for most tax equity, for most renewable energy tax equity investors and buyers. And so you'd like to like find a way to kind of pool them, basically aggregate the smaller ITCs on several affordable housing properties to make them worthwhile. In terms of what's too small, that ranges throughout the year. And so it can kind of go up and down depending on needs, et cetera. But I would say, generally speaking, if you've got ITCs under 5 million, that your sort of investor or tax credit buyer pool really shrinks. And when your credits are over 10 million, you start to really expand your options. 20, bigger's better, right? And so, but if you had like a bunch of small ITCs that aggregate to 5 million, that probably wouldn't fetch great pricing either. Because you got to do diligence on all those separate little properties. But we are, the affordable housing industry, right? I mean, they've been around for a long time. They know what they're doing. They're very sophisticated. They're very creative, and they know how to put together, financing partnerships to try to monetize all these related incentives pretty well. And so, I've talked to a lot of different affordable housing industry specialists that are trying to do just that. They're trying to find more efficient ways to monetize the solar ITCs on these affordable housing properties. So,
But look forward to the emails, Dirk, because I'll be including all of your contact information in our show notes. And I'm sure there's going to be a listener or two that'll say, Dirk, we need to talk.
Exactly. And now I guess I'll answer the question that you asked me, Mike.
In the election year season, not answering the question asked, I was impressed.
I should have just let it go. No. So yeah, the low-income housing tax credit, I guess, pricing market is a bit like, Brad had talked about, where we're the CRA component. So I don't think we're seeing as drastic as an impact in that market. Also when I talked to Tony when the IRA first came out, and I said, who are your investors? I don't really know who the investors are in renewable energy. And while there's some overlap, we found that there's not a ton of overlap between a LIHTC investor and a solar investor or a renewable energy investor. So, really, I think the industry, the LIHTC industry, they know the product, the credit works, just kind of staying within that market and not venturing into, learning a new industry. I don't think we've seen as much downward pressure as much as softening in the LIHTC market.
So, Dirk, I mentioned in the intro that think of the loan attachment market, there's the $10 billion or the 9% allocated credit market. And then there's the roughly $15 billion private activity bond or 4% market. What differences are you seeing in equity pricing between those? So, because over the years, there have been times when 4% were transacting for higher per credit dollar pricing because the tax losses on a 9% deal or a 4% deal, the tax losses are roughly the same, or they're the same size deal, but obviously the 4% credits are less than half. So when you measure it as a function of the equity dollars, it shows as higher. But then that kind of drifted where the pricing got to be, somewhat the same. And then there have been some really big bond deals where maybe the equity pricing on a bond deal was actually less than 9% because the market demand was as great. Where are we today?
Yeah, we are seeing a bit of a spread, I would say, between the 4% and 9% transactions. And again, this would have to be in a similar market. Comparing
Which way is the spread, positive or negative?
The spread would be the 4% getting a few pennies less than 9%. And looking at, the tax credits again, compared to the tax losses, and the tax losses only being worth 21% versus 35% pre Tax Cuts and Jobs Act. We are starting to see that spread in actually on our new tool should be showing that spread between the 9% and 4% within those markets.
Which does translate into the 4% transaction. If it's slightly less, when you look at the after-tax yield, that means the after-tax yield is slightly higher than the 9%. It's just a function of the market's desire for tax loss benefits versus tax credit benefits, as well as kind of other factors, which we don't need to go into here, but structuring other factors that can generate those results. And I guess a bit of a supply and demand effect as well. So we've covered a lot in the podcast so far. I think I'll use this as an opportunity to take a break, and then we'll restart in a moment with our second part of the podcast. But I did want to give each of you a chance to say any last minute words you wanted to share on this first of our 2-part series. And I'll let one of you volunteer to go first.
I can start us out, and I think it is going to be very interesting. The next 6 months to a year, just to kind of look at how the equity market is going to evolve, and we're going to talk about a lot of that on the next podcast. Just looking at where interest rates are going, potential legislation, the election coming up. I think it's all going to be kind of exciting times for the equity markets.
Yeah, I'll go next. And specifically for new markets, I think we're hearing a lot of discussions about what tax equity markets will look like for the remainder of the year because of the amount of deals that have closed already. And so I think that depending on whether or not the transaction closes in 24 versus 25 may have an impact on that. So that's something to keep in mind when looking for an investor for a new market tax credit transaction, and understanding kind of when that deal will close and what impact that may have on their pricing.
Okay, great. And so a couple things. Number one, if you are a tax credit transferee buyer and you're still looking for credits, even for 2023 or 24, feel free to reach out to me. We hear from a lot of our sponsor developer clients, and we generally have a pretty good sense as far as what credits are available in the market. So if you're looking to buy, please reach out. I also work with a lot of tax credit transferee buyers and would-be investors that are looking to get into the program. And so part of that involves me just helping to educate them on the various issues with respect to investing in renewable energy and other tax credits for that matter. And so if you're considering getting into the program and you need help understanding the various issues, I'd love to hear from you.
Great. Thank you for that, Tony. And so thank you, Tony Grappone. Thank you, Brad Elphick. Thank you, Dirk Wallace, for joining me on this part 1 of our 2-part podcast series. To our listeners, I will share contact information for Brad Elphick, Dirk Wallace, and Tony Grappone in today's show notes. Please do feel free to reach out to them, or not even feel free to, please do reach out to them and share any thoughts you have in terms of the comments they've shared so far. And next week, we will post part 2 of this series. And as you know, from the course of this part 1 of the series, in next week's podcast that we post, we're going to discuss the outlook for some major developments that will affect the supply and demand of community development tax credits, and concomitantly the equity value. And the discussion is going to include looking at the Community Reinvestment Act. It'll include looking at Basel. It'll look at the global minimum tax. We'll talk about accounting regulations. We'll talk about bank capital requirements, which is part of the Basel III. We'll talk about future tax legislation, either year-end tax legislation in 2024 or addressing the expiration of the Trump era tax cuts at the end of 2025, or at least major portions of the Trump era tax cuts. And as if all of those items aren't enough, there's going to be other topics as well. And before I go, I do want to remind our listeners and viewers, please subscribe to the podcast on the platform of your choice. I also encourage you to share the podcast with your colleagues who may be interested in one or more of the topics. And as always, please do leave a review of the podcast on your platform of choice. It helps others find the podcast. And I'll close by saying thank you, Brad. Thank you, Dirk. Thank you, Tony, for being on this podcast. I look forward to the second episode. And to our listeners, I'm Mike Novogradac. Thanks for listening.
This weekly podcast has been brought to you by Novogradac & Company, LLP. Archived podcasts are available online at www.novoco.com/podcast or by subscribing to the Tax Credit Tuesday podcast in iTunes, Spotify, YouTube, Google Podcasts, Stitcher, and Radio Public. You can find related links referenced in this podcast on our website at www.novoco.com/podcast. Novogradac & Company, LLP is a national certified public accounting and consulting firm with offices nationwide. Learn more about our professional services at www.novoco.com.